Sejahtera dan salam bahagia. Ladies and gentlemen, distinguished guests, esteemed participants, a very good morning to each and every one of you. Welcome to a momentous occasion. We've unlocked trading opportunities with Malaysia's first currency futures contract, the Mini USD CNH Futures, FCNH. My name is Kaylee and I'm your MC for this beautiful morning. First and foremost, on behalf of Bursa Malaysia, I would like to say a big thank you to every one of you. Thank you so much for joining us here. And I would like to promise you that the few hours coming is going to be a very insightful one. Together with that, we would also like to say a big welcome to our friends joining us online. Thank you so much for your participation. And folks, for information, we are also streaming over Facebook. And now, without further ado, let us celebrate this remarkable occasion, milestone, with the official launch of FCNH. With that, may I invite on stage Dr. Muhammad Umar Swift, the chairman of Bursa Malaysia Derivatives Berhad and the chief executive officer of Bursa Malaysia Berhad. Mr. Narendra Hegde, vice president in Hong Kong Exchange and Clearing Limited. And Mr. Muhammad Salim Karas Bakas, Director in Bursa Malaysia Derivatives Berhad. Welcome, gentlemen, and we'd like to invite our media photographers to step forward. And shall we have a photo opportunity before the launch? All right, look at our official photographer for a lovely picture. And here, kindly look at our media photographers for another round of photo opportunity. Shall we have one more? Well, okay. Well, right here, ladies and gentlemen, here is time for us to officially launch the Malaysia's first currency future contract, the Mini USD CNH future. I would like to invite the gentlemen to kindly place your palm on the panel after the count of 3 to activate the gambit. Here, gentlemen, kindly use your right hand and kindly place your right palm onto the screen after the count of 3 to activate it. So ladies and gentlemen, we hope you are ready for this. Are you ready? If you are ready, at a count of 3, 2, 1, place your palm and take it away. Ladies and gentlemen, right here presenting you Malaysia's first currency future contract, the Mini USD CNH Futures, FCNH. May I have our gentlemen to remain on stage and let's catch another photo opportunity, please. As of today, FCNH is now available to trade on Bursa Malaysia Derivatives. Congratulations, fellow Malaysians. Thank you. And here, we'd like to say a big thank you to Mr. Narendran and Mr. Salim. You may return to your seat. And I would like to invite Dr. Umar Swift to deliver his welcome address. Over to you, Dr.
Thank you, Kaylee. Mr. Narendra Hegde, Vice President of Hong Kong Exchange and Clearing Limited. Esteemed speakers, distinguished guests, members of the media, ladies and gentlemen, a very good morning to all and welcome to the Exchange. Today's launch of the Mini USD CNH Futures, or FCNH, marks a significant milestone for Bursa Malaysia Derivatives in introducing a new asset class, the first currency futures contract on our exchange. For this launch, we're delighted to be collaborating with Hong Kong X as one of our global strategic partners. At Bursa Malaysia Derivatives, our commitment to market expansion and progress is amplified through our innovative solutions and strategic partnerships as we support market participants in their business growth. The currency market plays a crucial role in facilitating trade and investment. Malaysia's significant trade relationship with China, our largest trading partner, for 14 consecutive years. Highlights the importance of currency stability. With bilateral trade between the two nations expected to exceed USD 190 billion in 2023, managing currency risk becomes increasingly vital for businesses across industries. Geopolitical tensions and rising costs intensify the need for currency hedging instruments. The Federation of Malaysian Manufacturers 2023 survey cited cost escalations of up to 20% for local manufacturers, emphasising the urgency of risk management strategies. Further, the growing preference by some for alternative currencies like the Chinese Renminbi highlights the evolving global trade landscape. Against this backdrop, the introduction of currency futures in Malaysia is particularly timely. This instrument will empower businesses with better risk management tools, allowing businesses to hedge against potential currency fluctuations and mitigate their exposure to volatile market conditions. This, in turn, will foster greater confidence and stability within the Malaysian economy, encouraging further growth and investment. Ladies and gentlemen, allow me to outline some of the key benefits we're bringing to the market participants with the FCNH. Firstly, FCNH establishes a transparent, regulated and accessible marketplace, benefiting SMEs and business owners engaged in transactions with China. This empowers investors to navigate dynamic currency market with certainty using FCNH as a valuable tool to hedge risks against USD and offshore renminbi fluctuations, ensuring stability in their business operations. Secondly, FCNH creates new trading opportunities for hedging renminbi currency risks across different assets. This smaller size cash settlement contract enables seamless trading, allowing investors to capitalize on price differentials and market inefficiencies across multiple exchanges, including Hong Kong and Malaysia's derivatives markets, without full principal exchange or physical delivery. Thirdly, FCNH attracts market participants to hedge against currency fluctuations, enhancing market liquidity and promoting the growth of our market ecosystem with secure and regulated environment. We aim to encourage increased participation from global investors, strengthening the vibrancy and competitiveness of our market. In summary, the FCNH contract represents a significant milestone, offering a range of benefits from mitigating counterparty credit risk to providing transparent, regulated trading opportunities. It empowers businesses, traders, and investors to confidently navigate the currency market, manage risk effectively, unlock growth opportunities, and thereby enhancing market liquidity. The launch of FCNH aligns with our recent signing just last month in Dalian, China, where Bursa Malaysia Derivatives entered into a licensing agreement with Dalian Commodity Exchange, or DCE, for soybean oil futures settlement price of the Bursa Malaysia DCE soybean oil futures contract, FSOI, set to be listed in 2024. This positions FCNH as an also important currency hedging tool for market participants interested in trading FSOI, which will be denominated in USD. The recent collaboration with DCE and the licensing agreement with Hong Kong Exchange for FCNH exemplify Bursa Malaysia's derivatives commitment to establishing strategic alliances and strengthening global market connections. These initiatives are anticipated to assist market participants in navigating international market complexities and effectively manage cross-market risks. Notably, these alliances deepen avenues for shared knowledge and expertise and a broader reach, making our market more resilient and responsive to the evolving dynamics of the financial landscape. At Bursa Malaysia Derivatives, continuous improvement and innovation are central to maintain a competitive advantage in the dynamic market landscape. In recent years, we have focused on enhancing our ecosystem to offer our clients greater flexibility and new trade opportunities. In 2022, we witnessed a substantial year-on-year increase, recording a 19.1 million contracts traded across all products. The global benchmark FCPO contract saw an extraordinary surge, reaching 16.2 million contracts, surpassing previous record highs. More recently, During the T+1 after hours on the 24th of August 2023, the exchange hit a new high of 21,210 contracts traded, surpassing the previous record of 19,065 contracts on the 1st of December 2022. Notably, the majority of these after-hour trades were for the FCPO contract. These results have earned Bursa Malaysia Derivatives the prestigious recognition of Exchange of the Year for Commodities and Exchange of the Year for Sustainability at the FOW Asia Capital Markets Award in 2022 and 2023. While these accolades solidify our position as a leading commodities marketplace in ASEAN, known for our green offerings, our dedication to progress remains steadfast. We continue to pursue developments that open out new opportunities for investors and traders, aligning our mission to creating opportunities and growing value. Before we delve into an insightful speaking panel session, I extend our sincere appreciation to Chen Dongjiang, Mr. Wang Zhouhao, and Li Hengui for sharing their invaluable insights. These contributions highlight the collaborative spirit that drives success in our industry. I invite you all to focus on the presentations and panel discussions, actively participate, and take full advantage of the networking opportunities available. Let us make the most of this event, forging new connections and fostering collaborations that will drive growth and success in the currency market. Once again, thank you all for being a part of this awaited occasion. I wish you an engaging experience, and I do hope many of you are excited about the launch of FCNH and will take advantage of this new derivatives product that is now seamlessly available in our market for you. Thank you very much.
Thank you. Thank you very much, Dr. Umar, for the heartwarming and insightful sharing. Thank you. Up next, ladies and gentlemen, we would like to invite Mr. Narendra Hegde from the Hong Kong Exchange and Clearing Limited to join us on stage for a speech. Please welcome Mr. Narendra.
Good morning, ladies and gentlemen. I am deeply honored to be part of this launch ceremony. I wish to thank Bursa Malaysia for inviting us to celebrate this milestone launch with you. First of all, I would like to congratulate Bursa Malaysia on the launch of their inaugural currency futures contract, the Mini USD CNH Futures. This milestone holds immense significance not just for Bursa Malaysia, but for the whole offshore RMB market. We are delighted to be the part of this product launch as the compiler of the contract's final settlement price. And we are grateful to Bursa Malaysia Derivatives for this invaluable partnership opportunity. The launch of Mini USD CNH Futures highlights the close ties between China and the ASEAN. Over the years, trade between China and ASEAN has experienced substantial growth. ASEAN remained China's largest trading partner on a regional basis, and China has been ASEAN's largest trading partner since 2009. The launch of the Mini USD CNH Futures will provide investors with a new tool to hedge against currency risks arising from increasing usage of the offshore RMB. The new contract addresses the growing demand among the investors as RMB has gained significant traction in global markets in recent years. The RMB retained its position as fifth most active currency for the global payments by value in August 2023, capturing a share of approximately 3.5%. However, the figure still lags behind China's 18% share of the global GDP, indicating a significant potential for the further growth of RMB. The expanding offshore RMB product ecosystem, including initiatives such as Hong Kong Exchange Connect programs, plays a vital role in driving RMB adoption across the globe. And today's launch will contribute to the diverse range of offshore RMB products, furthering the progress of RMB internationalization. Hong Kong, serving as an offshore RMB hub, acts as a crucial connection between mainland and international market. Notably, Hong Kong has the world's largest RMB capital pool, with the RMB deposits reaching RMB 984 billion by the end of October. As a super connector and gateway to China, we anticipate abundant opportunities for future collaboration with Malaysia extending beyond the realm of RMB. We are eager to strengthen our strategic alliance with Bursa Malaysia, working together to foster growth and development in the financial markets of our region. On that note, I would like to thank the team at Bursa Malaysia again for extending this invitation. The introduction of Mini USD CNH Futures marks a significant milestone, and we are truly excited to be part of this journey. Thank you, congrats, and wish you a huge success.
Thank you very much, Mr. Narendra, and please remain on stage here together with us. May I have you to remain on stage? Thank you. On behalf of Bursa Malaysia, we sincerely appreciate Hong Kong Exchange for being a part of the FCNH launch ceremony. For this, we would like to invite Dr. Umar Swift to present a token of appreciation to Hong Kong Exchange, witnessed by Mr. Salim Kadas Bakas. Gentlemen, kindly look at our official photographer and let's capture a beautiful picture here. Fabulous picture capture. Thank you very much, gentlemen. You may return to your seat and continue to enjoy the rest of the session. Thank you. Thank you very much. You may return to your seat. Amazing. Now, without further ado, let's move on to our presentation sessions. But before that, we would like to invite you to have a look at your table. We have placed a QR card on your table, and please scan it and use it to raise your questions during the Q&A session. Together with that, we have another QR code available here on your table, and you may use the second QR code to access the FCNH product booklet available for download from the website. Thank you. Now, ladies and gentlemen, our first speaker is Mr. To Yuen Lu, Head of FICC Bursa Malaysia Derivatives, who brings a wealth of expertise with over a decade of experience in treasury markets. Prior to his role here, he played pivotal roles in regional banks, specializing in structuring, asset and liability management, and even delving into the fascinating realms of gold trading. So please join me in welcoming Mr. To shed light on the revolutionary Mini USD CNH FCNH contract.
Okay, good morning to all the distinguished guests. I'm excited to present to you all this new asset class in the derivative markets. We are gathered here today for a momentous occasion, the unveiling of our currency futures, which is the mini dollar CNH futures. The China has been Malaysia's largest trading partner for the past 13 years. And according to the MITI forecast, the trade between the China and Malaysia are expected to grow further. And at the same time, the renminbi is the 5th most traded currency in the world. And with the volatility in the currency market for the past 1 year, we are in the timely to introduce a first currency futures for the benefit of the businesses to manage their FX risk at the same time, providing a participant with a new opportunities. So without further ado, let me introduce the product specification of these products. This is our first regulated marketplace currency futures, which is a mini dollar CNH, which is to unlock the trading opportunity with Malaysia's first currency futures contract. And this is overview of the product offered by BMD. For the past, we have our flagship products, crude palm oil futures, which is fall under the commodity derivative, and we have an equity derivative. At the same time, we have a financial derivative, and today we have a new asset classes, which is a currency derivative. And the first product under the currency derivative is a mini dollar CNH. So this is the contract specifications. The underlying of the mini dollar CNH is a dollar CNH currency pair. And in terms of the settlement methods, it will be cash settled in renminbi. And the contract size of this product is US dollar 20,000. And the minimum price fluctuations will be 1 tick, which is equivalent to renminbi 2. In terms of the trading hours, we have started to trade from morning 9 a.m. until 6 p.m. Malaysian time. And for our T+1 session, we'll start at 9 p.m. at night until 2:30 a.m. in the next mornings, which will provide all the participants a chances to cover all the risks, which include with all the major economic data release, as well as the monetary policy announcement as well. In terms of the contract months, we offer up to 2.5 years contract months available for the participants. So in terms of our final trading days, it will be 2 Hong Kong Futures Exchange business day prior to the 3rd Wednesdays. So in our final trading days, we will also be observing what is the Hong Kong holiday as well at the same time. But when it comes to the final settlement prices and the contract settlements, the final settlement prices we will be basing on the Hong Kong Future Exchange final settlement prices. Although we refer to the Hong Kong Future Exchange for the final settlement prices, but I will briefly to share with you all how is actually the fixing is done. So how does the rate of the dollar CNH being fixed? It will based on the TMA, which is the Treasury Market Association of Hong Kong, is the administrator of the dollar CNY Hong Kong rates. And he will be observing all the trades from 10:45 until 11:15 based on the Hong Kong time, with the transactions amount minimum of US dollars 1 million, and all the trade will be executed via all the approved money brokers. And it will be published and calculated by the Treasury Market Associations of Hong Kong around 11:30 a.m. in the morning. So what is the key benefit of trading the FCNH? Because currently in Malaysia, we don't have a regulated marketplace to the participants to trade in terms of the currency futures. But today, we are providing a regulated marketplace to all the participants, which is regulated by the Security Commission Malaysia. And second point, this is a greater capital efficiencies. This is not a full-size dollar CNH contract. It's a 1/5 of the full-size contracts, and it's a cash sectors. So in a way, it provides a capital efficiency renminbi currency hedging without requiring the full principal exchange or physical delivery to the participants. Because of this is a smaller size in terms of the FCNH contract, it provides a effective hedging and risk management tool. The businesses, they can more precisely to use the FCNH to hedge their risk against the fluctuation in the currency pair. And at the same time, this product is listed in the CME Globex. It's an electronic trading platform. It's available and accessible from anyone around the world. So I'm sharing with you some of the calculation of the P&L. The first one is the bullish scenario P&L calculation. The bullish is from the point of the US dollars. So when there is an expectation of the dollar's appreciations, you are going to, first step, what do? You're going to buy 2 contracts of the FCNH at 7.3, and you're going to sell 2 contracts at 7.31. So the calculation of the P&L, you will be 2 contracts times the notional of US dollar 20,000, it will be the notional of 40,000. The differences between the selling price and the buying price is 100 ticks. So the 100 ticks times the notional amount, it will be the renminbi 400, it will be the cross profits. Whereby for the bearish scenario calculations, is when there's an expectation of the dollars is expected to depreciate. It's going to sell one contract for the FCNH at 7.35 and going to buy back at one contract at 7.31. So it will be about 400 pips. It will be on the 400 pips times the notional of 20,000, and it will be equivalent to the renminbi 800 for the profits. Okay, so in terms of the characteristics, the list of the approved characteristics accepted by Bursa for this contract at the moment, there are three currencies. The first one is in ringgit, the second one is the US dollars, the third one it will be renminbi. Regardless of the various currency that we are willing to accept as a characteristic, but the settlements it will be in renminbi. And lastly, we would like to have a margin comparisons. You can see that across the three exchanges, Hong Kong Exchange, SGX, and Bursa, the settlement methods, last trading days, and the final settlement prices is the same across all the three products. The only differences is the SGX has a slightly different in terms of the contract sizes, which is offered 25,000 US dollars. But when we come to the margin requirements, the BMD will offer very competitive margin requirements for the participant to participate, whereby we only require initial margin of 2,500 in order for the participants to trade the contracts. And thank you. That's all for my presentations.
Thank you very much, Mr. To, for joining us on stage. Thank you. And now, ladies and gentlemen, get ready to delve into the world of the offshore renminbi market. Our next speaker is a seasoned expert with a track record in global markets. Please welcome Mr. Cheng Dongzhang, the Chief Dealer of Global Markets at Bank of China, Hong Kong Limited, with extensive trading experience and a specialized focus on the interest rate market. Mr. Zhang brings a wealth of knowledge to the stage. So having joined Bank of China, Hong Kong Limited in March 2022, he has previously made significant contributions at Citibank and China CITIC Bank. So without further ado, let's gain valuable insights into new opportunities and trends in the offshore RMB market. And join me to welcome Mr. Cheng Dongzhang.
Good morning, ladies and gentlemen. It's truly an honor for me to join the opening ceremony of the FCNH Future launch in Bursa Malaysia. This is actually my second time in Kuala Lumpur. The last time was actually 14 years ago. I'm very excited to see the many changes that have happened in this lovely city. Today, I would like to use this great opportunity to share some of my thoughts about the offshore RMB market, including bonds, FX, interest rate derivatives, and futures. I will also discuss how to further promote the bilateral currency cooperation between China and Malaysia. So first, let's take a look at the steps China has taken to open up its capital market. The development of the RMB market has been enhanced by the cross-border connect schemes. Since 2010, China has introduced several programs to encourage foreign participation and diversification of investments in the onshore bond market. China has allowed qualified institutions to invest in China's interbank bond market, which is known as CIBM, with offshore RMB since 2010, launched the RQFI programs in 2011, eased QFI investment restrictions in 2013, and relaxed rules governing institutional investors' participation in the China market as well. And the launch of northbound trading under Bond Connect in July 2017 has provided new channels for offshore investors to invest in the mainland China bond market and has accelerated the opening of China's capital market. This year, the Swap Connect program was kicked off. So in addition to the current offshore RMB rates products, such as the CNY non-deliverable IS, global investors are now able to access the onshore CNY IS market with deeper liquidity depths to hedge the interest rate risk during their bond investments. Along with the expansion of the bond market, the China interbank IS market has also received a boost, and CNY is currently the 7th most traded IS currency. With these successful connected schemes, the RMB has experienced fast growth in the FX market between April 2019 and April 2022. According to the BIS triennial survey, RMB FX trading volume rose by over 70% to $526 billion per day, making it the 5th most traded currency last year, up from 8th place 4 years ago, with a 4% share at that time. According to a working paper by BIS, the growth of RMB trading activities was mainly led by portfolio investments with institutional investors, funds, and other non-bank financial institutions. Let's use the non-bank financial institutions as an example. The left chart here illustrates the change of non-bank FI participations in the FX markets in the past decade, which we can see there is almost a 10% increase in RMB since 2013. Meanwhile, the right chart here demonstrates the bid-ask spread for each currency. We can see that the bid-ask spread for $CNY FX narrowed from 0.125% to 0.025%, representing improved market depth and liquidity. Other Asian currencies like IDR, Malaysia, Ringgit, Korea Won, Philippine Peso, Thai Baht are also narrowing, but currencies like Aussie dollar and Kiwi dollar are actually widening in contrast. This shows the trend of increasing development and market interest in Asian currencies. From this slide, we can see the movements in both the onshore and offshore RMB FX market in the past 5 years, including the gap between the onshore and offshore FX spot market. On the right-hand side, we are also comparing the daily onshore RMB fixing rate with the market estimate. The onshore market used to operate from 9:30 a.m. to 11:30 p.m., but the trading hours have been extended to 3 a.m. on the following day since this year. The offshore CNH FX spot market is a 24-hour trading market. In addition to the FX spot market, let's take a look at the FX swap market as well. We are using 3 months and 1 year tenors here as references, hoping to give everyone a better idea about the differences. The widest spike happened in August 2015, which I believe many of us can clearly remember. It was also noticeable in early 2017 when the RMB FX spot approached 7 for the first time in almost a decade. Afterward, with more types of participants and the launch of various connected schemes programs across the board, the depth and liquidity in offshore have been enhanced at a faster pace, which we can see that from the chart, the gap between these two markets has narrowed a lot. Now, in terms of the interest rate derivatives market, the trading volume in mainland China reached 21 trillion RMB last year, with IS accounting for a market share of over 98% by trading value, which is approximately about $3 trillion. The daily average IS trading volume exceeded 80 billion RMB. The participants in the China interbank IS market reached 753, including banks, security firms, AMC, investment products, and overseas investors. The main benchmark of IS traded in onshore are FR007, which we know as the 7-day repo fixing rate, and SHIBOR 3 months. Another major benchmark is the long prime rate. We call it LPR. since the reform of LPR quotation mechanism in August 2019. The volume of LPRs has increased rapidly. In terms of tenors, the proportion of trading volume in standard tenors, such as 1 year and 5 year, reached over 60%. The longest tenor for RS can be 10 years, but the liquidity for the 10-year is not as good as that of the 5-year. Earlier this year, a new Connect scheme was launched, which we called Swap Connect. Swap Connect is a new mutual access arrangement that enables investors to participate in the interest rate derivative markets in the mainland through Hong Kong. Investors can trade and clear onshore RMB RS products without changing their existing trading and settlement practices. This will give international investors a convenient channel to access the onshore RS market to better manage their onshore bond investments, thereby encouraging more foreign participation in the onshore bond market. Right now, there are 4 types of RMB-related RS available for offshore investors, which we can see from the right side. The first one is the non-durable CNY RS, also known as the CNY NDRS, as well as the second one we call the CNH RS, which linked to the 3-month CNH HIBOR published in Hong Kong. Above 2 are both traded in offshore market. Well, onshore CNY RS versus 7-day Ripple and onshore CNY RS versus SHIBOR 3 months, which 3 months and the overnight can be accessed through Swap Connect program. Then some people may ask why there is a need to access China's onshore RS market when there is already a fairly mature non-durable RS market. Here are some reasons. Firstly, the onshore market is more liquid. The bid-ask spread of onshore RS is generally tighter than that of offshore RS. Secondly, it's less volatile with deeper market depths, as the number of players and the size of transactions are much larger compared to the offshore market. Another major reason is the price difference between onshore and the non-durable RS. Offshore side, we usually use NDRS by deducting the onshore RS level for the same tenor to obtain the so-called NDD level. When there is no Bond Connect program, the NDD spread can widen in various cases. For example, on the left side, we can see that's the 1-year NDD spread, once widened to minus 20 basis points, and the 5-year spread widened to minus 40 basis points in 2015. After the launch of the Bond Connect program in 2017, the NDD spread is no longer that wide and narrowed a lot. However, the depth and the liquidity cannot compare with the onshore market. It is easy to observe one-way movement when offshore market players hold similar views. The following 2 graphs demonstrate the spread between onshore SHIBOR 3 months and SHIBOR and Ripple RS, which can be seen as the FRA OS spread in the US dollar market. However, due to the lack of liquidity in offshore SHIBOR, traditionally offshore investors couldn't hedge the risk accordingly. But now, overseas investors can access the onshore SHIBOR RS market through the Swap Connect program. Let's take a further look at the offshore RMB FX option market. Since 2022, US dollar CNH FX option trading volumes have become the 3rd largest among traded FX option currency pairs, following euro and yen. In some trading days, dollar CNH FX option, the volume can even surpass yen as the 2nd most traded FX option product. We do see a growing real demand and interest in this non-linear product as well. When it comes to the offshore RMB bond market, a variety of issuers have tapped into this market, including sovereign names, financial institutions, and corporates. For example, the People's Bank of China, PBOC, and the Ministry of Finance of China have both increased the size and frequency of issuing. CNH PBOC bills, and the China government bond in offshore. After the launch of the southbound trading program under the Bond Connect scheme, the issuance volumes have been robust and reached a record high this year, with certificates of deposit, private placements, and public offering accounting for 51%, 15%, and 34% respectively. In particular, we have seen a diverse background of issuers in private placement market, as more issuers have found the offshore RMB market to be a competitive financing alternative compared to the traditional US dollar denominated bond issuing markets. Now, let's take a look at the landscape of the CNH FX future market. The first derivable CNH FX future product was launched by Hong Kong Exchange in 2012. Later, 9 exchanges listed the CNH FX future products, including Hong Kong EX, SGX, and CME, among which Hong Kong Exchange and SGX are the most active markets for the CNH FX futures. This chart shows the future premium discount compared with the OTC market. We can see that during 2015 and 2017, when the dollar index stayed very strong, the exchange-listed CNH future traded at a premium compared to similar tenors in the OTC market. The one-year tenor of the future contract once widened to 500 pips. However, with the development and maturing of the future market, the future premium and discount has been traded in a very tight range in the past 3 years, which have gone through one currency appreciation plus one currency depreciation cycle. Currently, the top 2 largest exchanges in the CNH future market, as I mentioned, Singapore Exchange and Hong Kong Exchange, with daily trading volumes around $10 billion and $3.5 billion respectively. Bank of China Hong Kong has always been an important market maker in both Hong Kong FX, Hong Kong EX, and SGX, ensuring price continuity and providing offers for block trades based on clients' demand. We are very happy to work with Bank of China Malaysia together to participate in the CNH future market at Bursa Malaysia. With the development of the FX future market, more corporates and financial institutions will start to appreciate its benefit. Lastly, I would like to share our thoughts on how to facilitate the use of RMB in bilateral trade and the kind of service Bank of China can provide in Malaysia. I believe most of you guys have heard of the bilateral swap lines between the PBOC, the People's Bank of China, and Bank Negara Malaysia, which were established to promote the direct usage of RMB and Malaysia ringgit. In addition to that, as early as 2012, Bank Negara Malaysia designated Bank of China Malaysia as the local RMB clearing bank and successfully set up the local RMB RTGS payment system, which is conducive to efficient and safe RMB payments in Malaysia. We have also seen an increase in market participants opening RMB clearing accounts with us, including some from neighboring countries, to engage in more RMB-related business and facilitate the demands of local clients. As the RMB clearing bank in Malaysia, we are always ready to provide RMB liquidity and facilitate real demands in Malaysia or for the region. Furthermore, we provide Malaysia ringgit versus CNH direct exchange rates to our customers by leveraging the best market-making capability in CNH leg from Bank of China Hong Kong, as well as catering to diversified two-way client demands. Apart from the usage of RMB in trading business under trade account, there are other opportunities worth mentioning. We know that the interest rate of RMB has been relatively lower compared to other major currencies. This has created an opportunity for RMB to develop its funding feature. We have witnessed many market participants switching their funding currency to RMB, and we believe this trend will continue next year. If you have any questions or need our help, please come to Bank of China Malaysia. We are committed to provide a one-stop solution. I'm confident that the distinguished guests present today have heard about or actively been involved in RMB and the Malaysia Ringgit direct usage case. There will be opportunities and challenges presented by corporates and financial institutions based on trade activities, financing, investment, and hedging needs from end users, demonstrating the genuine demand from the real economy. Therefore, I truly believe that with a close relationship between China and Malaysia under trade and capital accounts, a lot can be achieved in the future. Yeah, that's all for today. Thank you.
Thank you. Thank you very much, Mr. Cheng Dongzhang, for the wonderful sharing. Thank you so much. Next up, we have Mr. Wan Zhuhao, the Director of Synergy Link Capital Private Limited. As a partner and Chief Technology Officer, he specializes in macro and technical analysis, emphasizing robust risk management. Mr. Zhuhao has been instrumental in designing a comprehensive risk management system. His expertise is sought after by various exchanges for training courses and regular market insights. So get ready to navigate CNH in the evolving global macro landscape with Mr. Wan Zhuhao. So let's welcome this gentleman to join us on stage.
If you have. Good morning, everyone. Good morning. Even though I'm not from Malaysia, but judging by the fact that I see so many familiar faces, that tells how much I've been traveling here and how much I love it here. Right? Very good morning. I would like to extend my thanks to Dr. Uma, Mr. Hegde for the warm welcome, and Mr. To for the introduction, and Mr. Zhang for the very insightful remarks. I'm grateful to the Bursa Malaysia Derivatives team for inviting me here to share my view on the Chinese yuan over the next 6 to 12 months. I think it's crucial to understand that in Forex, no currency stands alone. Right? It's essential to view global macro environment to enable to fully grasp the potential path for the Chinese yuan. This perspective forms the basis of my talk today, navigating CNH in the evolving global macro landscape. Now, a brief background about myself. I'm a partner and a director at Synergy Link Capital, a proprietary trading firm founded in Singapore over 12 years ago. We recently established a local Malaysian branch in KL and are engaging some very exciting local projects and partnerships, including with BMD. I am a trader first and foremost. So as a trader, my approach is always to accept the market as it is, as opposed to, not as what it's supposed to be. So I try to understand the probabilistic outcomes and the risk rewards. So I'll elaborate on that later as we proceed. Right. Now, before we dive in, I would like to share a few important disclaimers. First of all, please consider everything I discuss here as informational and hopefully entertaining. Right? This is not intended as financial advice. And secondly, the view I express here are solely my own and do not reflect those of Synergy Link Capital, Bursa Malaysia, or any other parties. And finally, a fun note. Many of the illustrations you will see in the presentation today are actually AI generated. Right? I find them pretty cool. And there are some Easter eggs if you have keen eyes. Right? I'm mentioning this because I had a lot of fun preparing this presentation, and I hope you enjoyed it too. Now, to start, I want to highlight two quotes from legendary investors you are definitely familiar with, right? First, from the always very insightful Warren Buffett. Be fearful when others are greedy, and greedy when others are fearful. So this begs the question, are we currently in a market of greed or fear? Well, the answer varies. In some markets, I would say greed is escalating, and in others, fear still dominates. Sir John Templeton, another investment legend, offered insights similar to Buffett's, particularly regarding the market psychology. Right? He said, bull markets are born on pessimism, grown on skepticism, mature on optimism, and die on euphoria. Right? Reflecting on current market assets, I believe we can map them to these different stages. For example, the US tech stocks right now, right, especially NVIDIA, the Magnificent Seven, or the surging gold prices, or the burgeoning interest in India, or Bitcoin's rise back to 40,000 US dollars. Now, focusing on China, we have seen a stream of negative news, from manufacturing shifts to fund divestments to real estate stress, and recently Moody's downgrade. Now, during a recent casual chat at the FIA event in Singapore, some friends from a Chinese brokerage firm told me that international interest in China has diminished notably since March, coinciding with the short-lived reopening optimism story. Now, my observation on financial Twitter, a platform where I often gauge the market sentiment, also align with this. There is a pervasive bearish outlook on China, yet this presents a very critical question for us traders and investors. Now, how much of this has already been priced into the market? If pessimism has peaked, if there's no more seller left to sell, if whoever needed to get out has already gotten out, so what's next for price? Right? As traders and investors, we can't only be looking at the real world mirror. We need to look forward. We need to anticipate. Now, let's shift our focus to currency analysis. Remember, Forex is inherently relative, right? We can't consider a currency in isolation. So I'm often asked about the predictions about currencies like the US dollar or the Japanese yen. My counter question is always this: against what? Is it in terms of the dollar index, which measures the dollar against the major development country currencies like euro, yen, and pound? Or is it against emerging markets currencies like the Turkish lira or the Argentine peso, right, which present a completely different scenario? Or perhaps it's the dollar's purchasing power against gold, which could be considered as another form of currency. Right? In this view, the dollar could simultaneously strengthen against other fiat currencies while weakening against the hard assets like gold. Right? With this understanding, we can now delve into China and the Chinese yuan. So let's start by considering the broader global macroeconomic environment first. This chart displays the size of the global economy based on GDP. So the dominant players are the United States, China, the Eurozone, and Japan. So their economic stature suggests a very significant impact on the Chinese currency. So in our discussion today, we will zoom in on the US, the Japan, and of course China to understand their influences more deeply. The US economy presents a particularly perplexing picture right now. Economy indicators are sending very mixed signals. On one hand, there are signs of remarkable resilience in the economy and consumer behavior. On the other, there are emerging indicators of potential problems, weaknesses, hinting a looming recession. So despite these mixed signals, the market seems to lean towards an optimistic scenario of soft landing or even no landing, Right? So this implies a balanced situation where inflation is effectively managed and real growth remains steady, avoiding both the resurgence of inflation and a recession. But is this balance the most likely scenario in 2024? At a recent press conference, the Fed Chairman Jerome Powell was questioned about the likelihood of a soft landing for the US economy. So his response was cautious and clear. No, I would not do that. While acknowledging the possibility or even the plausibility of a soft landing, Powell warned against premature optimism. He emphasized the existence of numerous factors beyond Fed's control, underscoring the uncertainties of the economy. The market's idea of this Goldilocks scenario, where everything aligns perfectly without any missteps, is exceedingly rare, fighting the highest inflation we've seen in decades while preventing a sharp economic slowdown is a formidable challenge. In essence, the Fed is performing a delicate balancing act, like walking a tightrope. We are in a state of the unstable equilibrium. So what it means is that imagine a ball sitting on top of the hill, where even a slight nudge could send it rolling down. Right? So this metaphor, I believe, describes the current state of the US economy. Stable for now, but vulnerable to any disruptive forces. Now, let's examine a few key charts among many economic indicators. A particularly predictable aspect of the economy is demographics and the unemployment rate. This predictability comes from the relative stability of this time series as compared to the more volatile and more stochastic or random series like the price charts. So this chart here, dating back to the 1950s, shows a very clear phenomenon. Rising unemployment rates are rarely false signals, right? The yellow circles mark a very few occasions where the unemployment rate increased, but then decreased again. However, as indicated by all these red circles, more often than not, an uptick in the unemployment continues significantly. So given this historical pattern and the fact that current unemployment rate in the US is still at historical low levels, even after Fed's aggressive rate hikes, I do anticipate a notable deterioration in the labor market ahead. Talking about hiking cycle, this is really one of the most aggressive interest rate tightening. So what do I mean by that? This is largely due to the concept known as convexity of interest rates and bond yields. Right? In simpler terms, a 1% rate increase has a more profound impact when it's from, say, 1 to 2% as compared to from 6 to 7%. So in just 2 years, the Fed has hiked US interest rate from near 0 to 5.5. That's a very aggressive move. The effects of these hikes don't appear overnight. They unfold gradually as consumers face higher mortgage and higher credit card payments, and companies struggle to service their debts and borrow money. One significant outcome has been one of the most inverted yield curve in recent history, with the 2-year yield surpassing the 10-year yield by over 100 basis points. Historically, such an inverted yield curve has been a reliable indicator or predictor of recession. But the critical point here that many people didn't notice is that recession typically occurs when the curves start to uninvert, as central banks begin cutting rates. So this is a phenomenon we call the bull steepening. So currently, we are observing the yield curve beginning to uninvert as the market anticipating rate cuts in the near future. In other words, the bond market is saying that a recession is coming. Equity market apparently thinks otherwise. So this leads us to the question, is this time truly different? The US equity market sentiment is reflected in the S&P 500 Volatility Index, or the VIX, reaching its lowest level since the pandemic. This decrease in volatility suggests a sense of complacency indicating a lower perceived need among investors to purchase downside protection. Right? However, it is crucial for us to remember the old saying, buy protection when you can, not when you must. Now let's focus on the US dollar, a very pivotal asset in the global economy. A long-term view of the dollar index reveals a very striking cyclical pattern with major turning points typically occurring every 3.5 years or around 42 months. A notable exception was in 2015, when the dollar continued its ascent rather than following the expected downturn. Apart from a few exceptions, like in 2003, when the dollar peaked, these cycles usually see the dollar reaching its low at the end of the cycle. With current cycle ending in 2024, and considering that the Fed is unlikely to tighten even further, it seems probable that we will see the US dollar reaching a low next year. So based on this chart alone, I think it's not unreasonable to see the dollar index fall back to, say, between 90 to 100 next year, in the next 6 to 12 months. Recently, as the Fed hinted the end of the rate hiking cycle, we have seen the US dollar weaken against other currencies, and US bond yields began to decline. These shifts have had a notable impact on gold prices, breaking a 3-year resistance and reaching all-time high last week. The US Treasury bond yield has had a huge rally since the hike began in 2022. However, right now, as we are at the end of the hiking cycle, bond yield, such as this 10-year bond yield, looks like it's about to break its 2-year ascending trend line any moment. So let's recap the US situation. We are seeing rising unemployment, declining bond yields, and the yield curve beginning to boost steepen. While the equity market remains relatively complacent, the bond market is starting to price in rate cuts, signaling a potential recession on the horizon. So this also aligns with the seasonal trend, suggesting a weaker US dollar in the coming year. However, in my view, the most significant macroeconomic event risk next year won't be from the US, it's going to be from Japan. This may be a surprising angle for many investors, particularly those who are not directly invested in Japan. You might wonder, beyond its amazing food, the stunning landscape, and the hospitable culture, why is Japan significant to the global financial market? The answer actually lies in the influential role of the Bank of Japan. Its policies and actions have, in many ways, shaped our modern financial markets. Japan has been a pioneer in unconventional monetary policies. Since the GFC, it was first to adopt the zero interest rate policy, the ZIRP, and the NIRP, negative interest rate policy. And Japan has maintained its ultra-accommodative stance, even as the other central banks have tried to normalize rates. So this chart shows the 10-year yield for major countries, including Japan, the US, Germany, China, Singapore, and Malaysia. Despite the diverse geographic locations, their economic stages, and demographics, you will notice a striking pattern. The bond yields move in tandem, albeit at a different magnitude. This synchronicity is due to the fungibility of government bonds, especially those in developed markets. The key implication is this. When the Bank of Japan suppresses JGB yields, it's effectively suppressing the global bond yields. And conversely, if the Bank of Japan normalizes its monetary policy, it won't just be the JGB yields rising. Global yields will follow suit. Remember, capital always flows to where it is treated the best. Japanese investors and pension funds, being a significant buyer of the foreign government bonds, especially the US Treasuries, are driven by the pursuit of better returns. With low yields at home, they've historically invested heavily in US Treasuries. Additionally, Japanese yen has been a popular currency for carry trades due to the low borrowing cost. Now, imagine JGB yields start to rise. The effect could be profound. Japanese investors may shift their focus back to domestic bonds, selling US Treasuries and buying JGBs, leading to a higher US bond yield. The unwinding of this carry trade could be rapid and significant given its massive size of trillions of dollars. As the borrowing costs in Japan increase and the yen strengthens, it's a double whammy for the carry trades. This chart illustrates the impact of yield differentials on currencies, showcasing a strong correlation between them. As the yield differential between the US and Japan widens, the US dollar typically strengthens against the yen and vice versa. In recent news, the Japanese yen has seen a significant movement, strengthening against the dollar. This change was driven by rising JGB yields as investors position themselves for a potential BOJ policy shift, possibly as soon as their next meeting, I believe is next week. I recall a similar situation last December. In a surprising move, the BOJ adjusted their yield curve control program, which combined with year-end low volatility led to a notable market fluctuation. We have established the likelihood of US dollar weakening broadly against other currencies and Japanese yen potentially strengthening against other currencies. This chart is truly something to behold. Since early 22, the US 10-year yield, the dollar yen, and the USD CNH have moved almost in sync. Historically, the yen and the yuan haven't shown such a strong correlation as we observe now. This correlation stems partly from Japan and China being export competitors. Both countries' economies rely heavily on exports, and a weaker currency offers a competitive advantage. Currently, the yen is at the weakest point against the yuan in nearly 3 decades. When the yen strengthens broadly, China can afford to let the yuan strengthen without losing its export competitiveness, as compared to if the Chinese yuan unilaterally strengthened against the Japanese yen. And not only that, the timing of this phenomenon is quite interesting. It started when Fed began its hiking. Therefore, I believe the move of both currencies against the US dollar is largely driven by the US bond yields. As previously mentioned, Japan and China are the largest and second largest foreign holders of US Treasuries, respectively. These holdings are critical components for their foreign exchange reserves. Consequently, fluctuation in the US Treasury yields exert a substantial impact on their currency's values relative to the US dollar. When I prepared the slides on December the 2nd, the Japanese yen was on the brink of breaking out this ascending channel. Then, on December 7th, we witnessed a significant event. The dollar yen experienced a 3 standard deviation move, dropping below 142 briefly, indicating a break from this channel. So in my view, this set the stage for the yen to strengthen considerably over the next 6 to 12 months. To summarize the situation in Japan, we anticipate the Bank of Japan to begin normalizing its monetary policies. This shift is likely to result in higher JGB yields and a stronger yen. Additionally, this could trigger a self-reinforcing loop of unwinding a massive carry trades. A strengthening yen would also provide more leeway for the Chinese yuan to appreciate, particularly in the context of a broader weakening US dollar. With our understanding of the global macro landscape now in place, let's turn our attention to China, a market currently enveloped in fear. Reflect for a moment, when was the last time you heard a positive economic news about China? Turning to the Chinese domestic equity market, it's noteworthy that since 2007, despite a few booms and busts in between, the market has largely stagnated. However, the Shanghai Composite Index is currently at a very pivotal 2-decade support level, which has historically marked the local bottoms since 2005. Such significant support warrants our close attention. Additionally, the market is nearing the apex of a larger symmetrical triangle. Significant, it means a compression of the highs and the lows. So from a technical perspective, a breakout seems sooner rather than later. So given everything we have talked about so far, I lean towards upside breakout. Similarly, the Shenzhen Composite Index mirrors this pattern. It's currently sitting at a crucial multi-year support level, echoing the significant technical juncture we observe in the Shanghai Composite. This alignment further underscores the potential for a notable movement in China equity market. Turning to the intriguing USD-CNH pair, let's start by examining its long-term trajectory. Since 2010, it has been following an ascending channel, and particularly from 2015 onwards, we can identify 3 distinct similar cycles, or 2.5, because the last one is still unfolding. In each cycle, the US dollar strengthened against the yuan, moving from the channel's bottom to the top. After reaching these peaks, the momentum slowed, failing to achieve another new highs, and then followed by a rapid decline, much faster than the ascent. To understand the implication of these cycles, let's take a closer look at what transpired during these periods. In August 2015, the People's Bank of China's unexpected decision to devalue the yuan by nearly 3% triggered some significant global market volatility. This move raised concerns about China's economic health and led to the tightening of capital controls as China sought to stabilize the yuan and its forex reserves amid slowing GDP growth and ongoing economic reforms. During the period, the US dollar continued to strengthen, reaching its peak in 2017. By then, China's economic indicators began showing signs of recovery, restoring investor confidence. So this period also coincided with the synchronized global economic growth. The turning point of this cycle came with Fed Chairwoman Janet Yellen's dovish comments on keeping the interest rate low, followed by her notable statement about not foreseeing another financial crisis in our lifetime. And we all know how that one turned out. Following the policy adjustment by the PBOC to further support the yuan, the US dollar began a sharp decline against the yuan, continuing into 2018. In mid-2018, the intensifying trade war between US and China, marked by significant tariffs, began to shake the global economy. Additionally, diverging monetary policies emerged. The Fed was tightening, while the PBOC remained accommodative. These factors, coupled with the uncertainties from the trade war, led to a stronger US dollar against the yuan. By 2019, as global economy growth slowed, the Fed halted its tightening policy. Then the pandemic struck. The initial was a flight to safety that favored the US dollar. However, aggressive monetary easing and fiscal support by major central banks, including the Fed and the ECB, were implemented to help the economic recovery. Meanwhile, China's effective initial pandemic control and subsequent economic rebound contributed to the yuan's recovery against the US dollar, continuing into late 2021. In 2022, as major economies mostly recover from the pandemic, new challenges emerged. Inflation, fueled by various factors, including monetary and fiscal policies and supply chain restructuring. The Fed, in response, began aggressive tightening, sparking a significant US dollar rally last year. The beginning of 2023, this year, we saw China reopening. Initially, you get a lot of investors excited. However, this optimism was very short-lived. The China reopening narrative didn't unfold as expected, with China encountering several economic hurdles. Consequently, the yuan weakened against the US dollar from the second quarter. Now, we are at a very pivotal point. the USD CNH hasn't surpassed the previous high of this cycle, and with Fed's hiking cycle concluding and the economic issues emerging in the US, the pair is at a very critical juncture. Positioned at the 2-year trend support line and potentially the neckline of a rounding top, the USD CNH is now facing a very decisive moment. Considering a seasonal trend towards a weaker US dollar next year, it appears that likely the USD CNH will break this support and initiate the downturn of this current cycle. So far, we have explored various charts covering the US, the Japan, China, and the Chinese yuan. As a trader and a student of the market, I rely on these visual tools to interpret what the market is trying to tell me. I believe in accepting what it is rather than what I think it should be. So regarding China, my conclusion is this. Sentiment is overwhelmingly bearish. Positioning is heavily one-sided, and technical indicators are all at a critical juncture. While the global macro environment supports this outlook, fundamental indicators have yet to signal a stabilization or a reversal. This, however, is the whole point. If fundamentals have already clearly indicating an improvement, we might be too late for an optimal market entry. Already in the second stage, perhaps the skepticism phase of a bull market, as per John Templeton's framework. Could I be wrong? Absolutely. But in trading, I seek opportunities where the risk-reward is heavily skewed. Markets inherently lack certainties, right? It's in these uncertainties that opportunities arise. At this moment, with the prevailing bearish sentiment and due to the absence of fundamental reversals, the prospect of investing in China and the yuan becomes increasingly compelling to me. As we come to the end of the presentation, I want to bring back these two very wise quotes from Warren Buffett and John Templeton. This pervasive pessimism surrounding China's market might very well be the backdrop against which a new bull market is born. As we have explored today, such moments of widespread doubt often precede significant shifts in market dynamics, presenting opportunities for the astute observer. Perhaps in the climate of uncertainty, we are now on the cusp of witnessing the genesis of the next market upturn. Before we conclude, I would like to briefly introduce the educational arm of Synergylink Capital, Inspirante Trading Solutions. It's co-founded by myself and my partners. We actively collaborate with various exchanges and brokers to write market commentaries and research articles. Our publications and trade ideas are available on major platforms like LinkedIn, Substack, and TradingView. So if you are interested in our approach and would like to explore more of our research and our discussion of trade ideas, I encourage you to check them out. And with that, we reach the end of my presentation today. It's been a thoroughly enjoyable experience preparing it as well as sharing it with you today. I hope you enjoyed it as much as I did, and I look forward to the panel discussion with my fellow panelists.
Thank you. Thank you very much, Mr. Wan Juhal, for the wonderful sharing. Thank you. Ladies and gentlemen, now before we proceed for the next session, let us have a quick pause session. Kindly scan the QR code that we have placed on your table and join the Slido for a pause session. Or you may scan the QR code that we have placed on screen. All right, so here we have our poll question. Based on current USD/CNH exchange rate 7.8140, what is your prediction for the movement of the USD/CNH exchange rate in year 2024? Do you think it's A, Chinese offshore renminbi will appreciate 2% against US dollar. Or B, Chinese offshore renminbi will depreciate 2% against US dollar. Or C, Chinese offshore renminbi against US dollar will fluctuate within a range of 2%. So is it appreciate 2% against US dollar, depreciate 2% against US dollar, or fluctuate within a range of 2%? What's your thought? Very interesting result we have here.
Check. I think there's a typo on screen. The exchange rate should be 7.1840, yeah, rather than 7.8140. So just as a motivation for you to participate in this session, we had the same polling, or rather survey session when we relaunched our gold contract last year, right? So just to let you know that the poll result, the outcome, was actually accurate. The gold was trading around 1,008 at that moment, right? We were having this poll, and the crowd were predicting the gold price to be trending towards 2,000. So that proved to be accurate. So maybe just a call for action. Do participate. Wisdom of crowd. We'll see whether what we will get in a short while. Another 20 seconds for you to put in your response.
Oh, this is a very interesting poll questions that we have here, and we can include it in our discussion later.
It can be continuous or what?
We can
No, right.
do it during the panel discussion. Don't you think that is going to be a good discussion over here based on this amazing topic that we have here?
Okay, sure.
All right, final 10 seconds for you, Vix. And here.
Well, so looks like majority of the audience here is voting for a bullish renminbi next year. It will appreciate by 2% against the US dollar. So, but this is not a trade recommendation. Please do not take this as that. This is just for fun and just to get people more involved in the session.
An amazing interactive sessions that we have presented to you here. Thank you so much for your participation in the post session. Now, as we conclude the presentation sessions, let's transition into a dynamic panel discussion. So we have our moderator for this insightful panel discussion is none other than this gentleman here, Mr. Ryan Leung, Head of Product and Market Development at Bursa Malaysia Derivatives. And joining him on stage are our esteemed panelists. We have Mr. Cheng Dong Zhang, Chief Dealer of Global Markets at Bank of China, Hong Kong Limited. Mr. Wan Zhu Hao, Director of Synergy Link Capital Private Limited. Mr. Lee Heng Jui, Executive Director of Social Economic Research Center, SERC, in ACC CIM. Welcome, gentlemen. Please join us on stage. Together, they will navigate the path to diversification in currency trading, discussing challenges, opportunities, and the evolving role of renminbi. So here, I shall hand over the floor and the stage to Mr. Ryan. Over to you.
Thanks again, our esteemed panelists, Mr. Zhang, Mr. Wan, and Mr. Lee, for joining this very instrumental, or rather important event of Bursa Malaysia Derivatives. This is the launch of our first currency futures contract. So it is actually a very important key milestone for BMD. Welcome, all three of you. Allow me to do a short introduction of the global FX trade. Yeah, and of course, the topic of the panel discussion today is navigating the path to diversification in currency trading, the challenges that we see. Of course, challenges comes with opportunity and the evolving role of renminbi, right? So as an introduction, there have always been talks that the international role of USD may be challenged, right? The reason can be China's growing prominence in the global economy, even the development in blockchain technology, right? We see the emergence of cryptocurrencies over the last 5-10 years, right? Of course, it can be due to geopolitical consideration. The global FX market remains concentrated in a few key currencies, with the US dollar holding on to its prominence, or rather dominance. Yeah? The US dollar average daily turnover on one side was 6.6 trillion last year, 2022, accounting for nearly 90% of global FX transaction. This is according to, this is official number from the Bank for International Settlement. It's not from Ryan Long. So, and of course, the euro is the second most traded currency with a share of about 31%. The share of euro has been trending lower, including Japanese yen and even British pound, as we see a shift in trading of these major currencies to emerging market currencies. One of them, of course, is renminbi. Yeah? So renminbi share in global FX trades has increased from less than 1% 20 years ago, and is currently near 7% of global FX transaction. Yeah? When we talk about euro, I still remember it was back in more than 20 years ago. I believe the euro was introduced back in 1999. So people were saying, this is it, right? Euro is going to challenge US dollar dominance and all that. Then came Brexit and all that. And of course, this is a topic for another day. We also know that the US dollar is known as a vehicle currency for FX trading. Very little non-US dollar currency pairs exchange directly, right? I think Mr. Wan mentioned earlier, when we trade currency, it is always the relative value of the currency pairs. Yeah, it is not one-sided. It is estimated that this vehicle role of US dollar drives close to 40% of the turnover in US dollar in the FX market. Yeah, and of course, we also know that US dollar is the most issued currency in the offshore funding markets, where about half of international debts, securities, cross-border loans are denominated in US dollar. Ironically, a lot of times these lenders and borrowers, they are not US resident. They don't really have to do that. The US dollar is also the most widely used currency in international trade and global payments, while approximately half of the global trades are invoiced in US dollar. Yeah, so this is just a bit of background. However, one area where the role of US dollar has been shrinking is as foreign exchange reserve. Currently, US dollar accounts for less than 60% of official foreign exchange reserve, well below the 20-year average of 65%. At one point, it was more than 70%. Yeah? So non-traditional currencies like the Aussie dollar, Canadian dollar, Swiss franc, Chinese renminbi have played a larger role in global foreign exchange reserve. The increase in the share of this reserve in renminbi accounts for about a quarter of the shift away from this, the usage of US dollar in recent years. Russia alone holds nearly a third of the world's renminbi reserve. Yeah? Renminbi has close to a third of their reserve in Chinese renminbi. Some other countries also hold renminbi as reserve. They are like Brazil, Switzerland, Mexico, Chile, South Africa. Yeah. So I hope this short introduction we have set the stage properly for our discussion session with our panelists in a short while. I have already received a number of questions, but I would like to start with a few that is being suggested to me privately. Yeah. So question number one, do you see any apparent change in the trend of usage, or rather diversification of trade settlement currency away from over-reliance in the usage of US dollar? Right? How does this de-dollarization impact on the global economy, capital flow, and international monetary system? I would like to perhaps direct this question to Mr. Lee for you to respond. Thank you.
Thank you, Ryan. Good morning to everyone. Thank you again for inviting me for Bursa. This is my second time here. I had it about a few years ago about the equity market. So I am a trained economist. So today I'm not going to tell you about how to trade in the forex market, but just give you a global perspective of how the question in response to Ryan's question. I think the process has started. The process of replacing dollar as the global reserve currency has started, but it's still very gradual because we cannot afford to see a major shift in the de-dollarization because the impact will be very significant on the global market, on the global economy, capital flows, and exchange rate volatility. I think since the global financial crisis, a lot of countries from emerging markets start to question the viability of the dollar-based monetary and financial system in the trading, in the regional trade. Yeah? I think a lot of leaders, including our Prime Minister, have started to ask a question, basic question, why our trade are not settled in our own currency? Why should we continue to rely on US dollar as a trading currency, whether it's for cross-border trade, financial, and activity? So I think over the last few years, we observe a lot of countries, starting with China, Russia, and even some of the countries in Middle East, or even our neighbor like India, has taken initiative to reduce the over-reliance on the US dollar to be part of the what I call the reference currency, anchor currency, or trading currency. And that has started to move away, and we saw it intensify because US policymaker has been using US dollar as a weapon to part of the global strategic, geopolitical, economic, or political decision for you to you must rely on me and I can control you from behind. You're my puppet. So that make a lot of countries start to think, we must work out something to reduce the reliance on the US dollar. And that we saw happening. So to give you some perspective, the way China has started to buy the commodity from Russia and using the renminbi and vice versa. And India, I observe India has been very aggressive. They have engaged in bilateral relationship with some of the country, UEA, Bangladesh, even Malaysia, to internationalize their currency, rupee. Yeah? And also you look at Australia and China, the trade in tin ore also use the currency of China renminbi currency. And in fact, we can see China denominated crude oil future market was launched in 2018. And Korea and China, including some of the ASEAN countries, which China has engaged aggressively in terms of the bilateral swap arrangement. In year 2022, we had about 38 bilateral swap arrangement between China, Bank of China, with some of the country central bank involved about 4 trillion renminbi. What does it tell you? China is making initiative to make its currency more acceptable in the global stage. But there are something that China needs to do more now because the capital account is still very restrictive. To meet as a reserve currency in the world, you must have 3 criteria: as a unit account, as a medium exchange, as a store of value. I think this part, I think China will have to work harder in due course to liberalize the capital market and make more liquidity of renminbi in the global market. And then people will be more acceptable to accept renminbi because there will be more asset class for you to invest. So to summarize, if you look at in terms of the statistic based on SWIFT, we track very closely, you can see that percent share of the US dollar as a percent of global payment has fallen, as what Ryan said. I think the latest data is about 54%. If you based on IMF data, as a reserve currency is about 58.5 from the peak, about 72.1% in year 2001. And now renminbi is about global international payment currency, about 3.7%. And in fact, surprisingly, Canadian dollar is coming up, New Zealand dollar is coming up, and Aussie dollar is coming up. So things are moving along the path, what we call de-dollarization. But I don't think it will be very significant shock to the dollar. It will be gradual until everyone accepted, because whatever changes to the dollar will impact on individual currency in terms of capital flows, in terms of financial monetary policy. So to answer the second part of the question, how would that impact on the global economy, on the capital flows, on monetary policy, or international trade? Let's start with the global economy. I think for sure, if there is a very disruptive de-dollarization happen, US economy will be affected significantly. The loss of confidence of the dollar, the US dollar asset will be less attractive, capital will flow out, and the immediate impact will be the bond yield, the US Treasury spike that will cause a lot of impact on the market, and recession may set in. And when US in recession, the rest of the world will have to go along with it. That is on global economy. On capital flight, I think there will be significant capital flight if there's a loss of confidence, investor sentiments affected due to concern about a de-dollarization in a very abrupt manner, cause a shock to the US economy, then capital flight will happen, and that will create a lot of volatility in the forex market, in the capital flow. And third is on the monetary policy. I think the first basic why central bank would like to reduce reliance, over-reliance, I would say, over-reliance on US dollar is to give them a lot of flexibility for them to conduct their interest rate policy and control their money supply according to their domestic economic condition. And you can see a lot of country, it's about more than 60% of most of the country currency is pegged to dollar. So when US dollar strengthen, just like in the case of Hong Kong dollar peg, you have no choice, you have to follow accordingly. Like in the case of Malaysia, we are not pegged, direct pegged to dollar. We have the monetary independence to conduct the way how we want to raise interest rate or to lower interest rate in response to the domestic economic condition. But there's a price to pay because capital outflows from the domestic market, in the case of Malaysia, then ringgit will have to stomach the weakness. So central bank will have to assess, should I rescue the ringgit or should I rescue the economy? I think economy will be outlive the priority of the policy. And then on international trade, I think from a simple angle, if dollar continue to decline sharply, that will improve their competitiveness, but there will be effect on their domestic inflation. So the net effect, again, will depend on how much the de-dollarization process take place. So my take, international trade, there will be plus and minus in terms of the volatility in the exporter, importer, your hedging costs could increase because you have to deal with multiple currency as you slowly reduce your over-reliance on the US dollar. So in summary, De-dollarization is a very multi-complex process. And the impact on individual country in terms of whether the capital flows, monetary policy, international trade, it depends on how you as a country, if you want to reduce reliance on dollar, you must work together with other countries in a very effective planning. Yeah? Approach must be effective coordination. I think we saw how the ASEAN country works. I think beginning May this year, most of the ASEAN countries decided to set up a task force. That task force is to look at how do we encourage our local currency as part of the payment system. So over time, we will try to use our own currency to trade. And of course, we anchor on the renminbi, because most of the ASEAN countries, they are major trading partner with China. In particular for Malaysia, I think we have been the largest trading partner for the last 14 years. And based on Bank Negara statistic, which they share with me, between the bilateral trade between China and Malaysia, the settlement percentage of settlement use renminbi is about 25% now. It's very huge. But I tried to track the data from the SWIFT. Some told me that may not be so high, but from their statistic they share with me, is from less than 1-2% has jumped significantly to about 25%. This is a very good sign, for us to, in particular for Malaysia and ASEAN country, to pursue, the path of using renminbi as a cross-border payment, whether it's a financial trade or even people-to-people movement. Yeah, I'll stop here. Thank you, Ryan.
Thanks, Mr. Lee. Mr. Zhang, would you like to also share your opinion?
Sure. I totally agree with Mr. Lee, and almost Mr. Lee covered all I want to mention. So probably I want to share some data points here to make some supplements. And the trade volume between ASEAN and China increased to 6.5 trillion RMB last year. The use of RMB in cross-border business between China and ASEAN countries continues to grow, as Mr. Lee just mentioned. Around 1.5 trillion RMB has been directly used under the current account last year, which represents around 61% increase year over year, and nearly a 20-fold increase over the past decade. So Mr. Lee mentioned it's like roughly between China and Malaysia, it increased from 1 to 2% to 25%. And the data I have here is like 20 times increase, so it's pretty in line. And the use of RMB in cross-border business between China and the ASEAN countries, roughly it's account for like 20% on average. And if we take a closer look at the cooperation between China and Malaysia, Malaysia is definitely a key trading partner for China in the ASEAN region. In last year, the bilateral trade numbers reached 1.39 trillion RMB, and representing an increase of around 74%. Under the capital account, Malaysia has attracted around 3.6 billion Malaysian ringgit in direct investment from China. So these numbers demonstrate that more market participants would like to diversify their assets and investments and prefer to directly use local bilateral currency to mitigate the FX risk. Thank you.
Thank you, Mr. Zhang. I have a question for Mr. Wan. So Mr. Wan has, from the very beginning, brand yourself as a trader. Okay, so this is a question for a trader. So how has the trading of direct or non-US dollar-based currency pairs been? Are they actually less volatile? Would the increase in trading in such currency pairs be beneficial in encouraging more bilateral trades? For example, within ASEAN region, if you could share.
All right. So I will approach this question from a very narrow trading perspective. Right? I'll leave the macro, the economy to maybe Mr. Zhang. Right? So from a trading perspective, or at least for us, we trade mostly exchange-listed derivatives, right? Futures, options, so on and so forth. Right now, we do not have many direct or non-USD based currencies, right? But it's a very encouraging sign that BMD start to list this CNH USD contract, and we certainly hope that in the future we could have something like a direct or non-USD base. The reason is that, like I mentioned just now, if you look at the currency move over the last year, for example, from 2022 till now, I would say the main driver of the currency move, any currency, is the US, right? It's the US monetary policy, is how the US yield did, right? However, when we are trading, we may not, sometimes, okay, let's say in our firm, we trade a lot of cross-exchange products. Right, for example, Bursa FCPO is one of our highest volume products. We trade it against other correlated products like the palm oil in Dalian, right? So when we establish something like this, which we trade a lot, you can see that USD is actually not in the picture, right? So we would love if we could have a way to, to be able to hedge our exposures without going to USD or without synthetically create a currency pair without the USD, right? But like I said before, I think this kind of non-USD based currency pairs are still in a very, very early stage, at least in terms of the exchange listed derivatives, right? And we, as traders, we certainly hope to see more. Thank you.
Thanks, Mr. Wan. Mrs. Zhang?
Sure. And I'm also a trader, so make some comments further on it. I think in addition to, like, say, China and ASEAN region, we can take another look in the European area. Because the UK and Europe is a very typical example for the direct trade and the local currency. So based on let's take a look at the economic value. So last year, the UK actually exported around 340 billion pounds of goods and service to the EU, which accounted for around over 40% of total UK exports. And the UK, at the same time, imported around 432 billion pounds of goods and service from the EU region, which accounted for over 45% of the total UK imports. So it's very obvious that the UK and Euro region are actually highly related. And let's using the trader's methodology. So let's take a look at the Euro and the Sterling FX, the realized volatility against the dollar. So for this year, the realized volatility for Euro is 7.5%, and Sterling-wise, it's 8.6%. So it's annualized volatility, respectively. However, when we take into consideration for the cross, say Euro-Sterling direct currency pair, the volatility is actually only 5.4% annualized. So it's dramatically reduced. And similar trends can be observed for the CNH and the Malaysia Ringgit as well. So CNH volatility this year is 5.2%, while Malaysia Ringgit is roughly 6%. And the CNH Malaysia pair for the direct has only less than, like, say, 5% volatility. So therefore, trading in direct local currency pairs will definitely help mitigate the unnecessary volatility. And another thing I want to mention here is about when I join the markets as a trader, the textbook you first observed is they will tell you we have the base currency and the foreign currency. So the base currency in the front, which is not US dollar, only has Euro, Sterling, Kiwi, and Aussie, while all the other currencies are based in the dollar denominated. So it's actually, I think it's a market behavior set up after the, like, say, after World War II or 60 to 80 years ago. But I think this trend can be gradually be changed as the usage of the direct currencies between two local countries will be increased a lot. Thank you.
Thanks for sharing that. So it is good to know that many of the direct currency pairs has got lower volatility. My next question, it is addressed to all three panelists here. I've been struggling to structure this sentence properly so that all three of you can participate. So wearing your own cap, as in considering from your existing role and capacity, how can various market participants like businesses, investors, and even professional traders adopt the use of derivative product like FCNH that we are launching today in their favor? The floor is yours, Mr. Wan, Mr. Lee, and Mr. Chang.
Okay, maybe I'll start first. I believe that as long as you are in this financial market, right, whether your role is operating a business or investing in a business or trading, right, speculating, no matter what your role is, you are essentially risk takers, right? Makes sense, right? Because the whole point is you want to take some risk and get compensated for doing so. Now, it's therefore very, very important to understand before you even start any project or any initiatives, what is the risk you want to take and what is the risk that you do not want to get exposed to, right? Because when we are in the market, there's seldom that you are only going to get exposed to one kind of risk, right? The risks are always multidimensional. So this makes total sense for any market participants to leverage wonderful tools like the FX derivatives. For example, let's say when we are trading a pair, for example, the Malaysian crude oil versus Dalian, Malaysian crude palm oil versus Dalian's palm oil, okay? Our angle is that, we have a statistical model of how these two assets should behave, and we want to take advantage of that. However, FX or currency exposure is not something we want to be exposed to, right? So if that is the case, we certainly want to use the tools like the CNH or any other available tools for us to hedge out this part of the risk so that we can be rightly compensated for being right about the model, right? Because sometimes if you're not careful, the FX loss can eat away whatever profits you make from your actual trade, right? So this is the part of hedging out your risk. And the second part is definitely is more straightforward. If you have a view, if you want to participate in terms of the speculation, this is also a very, very good tool. And it's exchange listed. For us, we prefer exchange listed products. It's, we don't need to worry about any kind of counterparty risk. It's very, very liquid. The margin is, the margin requirement is very low, very capital efficient. All these are the benefits for the market participants to consider tools like this. Thank you.
I will share from a perspective as economist and also a think tank of the Chinese Chamber. So before I came to this forum, I did a very quick take survey about how our businessmen, Chinese Chamber community, do they engage into hedging or whether they using a lot of renminbi to settle on their trading with the China counterparty. So we survey 4 companies, no names. These are in the beverage products, wood-based products, automobile-related products, and last is the food products. 4 of them use renminbi to settle, vice versa, with their counterparty. And I think one of them commented, they accept renminbi as can be used for payment, which can also be more than what they receive hassle-free in exchange for more renminbi. But they also comment US dollar is relatively more advantageousness for hedging exercise, and also for other import payments. So I think what I understand that hedging is something that part of to manage your exchange rate risk. I think that is in terms of the understanding the product out there is still relatively not too deep for a lot of small SME lah. So I think bankers and even like Bursa, who you launch this product, it's not for trading lah. It's more like what you mentioned is about for your hedging against your exchange rate fluctuation risk. I think that there should be more engagement, yeah, with people like our chamber or even those at the SME for them to understand. And the other thing is that they are quite concerned about how much the cost lah, hedging. That is something that the cost of hedging, that could be one in particular for Chinese businessmen. Every cent count, right? Not just from Penang people, but every cent count. So I think it matters to them. You know what I mean? So I think this is something that we can work on, even with our bank or BOCM Malaysia and also other bankers. Okay, thank you.
Just let me add to what Mr. Lee commented. I think that's a good news, right? I actually like to hear that there's a huge untapped market, right? Many of the businesses in Malaysia who is doing business overseas, buying from overseas company or selling to overseas companies, not the big ones, right? Of course, the multinational company has got access to the banks and all that. But for SME, I think there's still a lot of untapped market. So I think this is also a very good news for all the TPs who are in the audience today.
Yeah, I agree with previous panelists' idea. And in addition, I think another thing not mentioned here is since Mr. Wang is mainly trading in the exchange-listed products like futures and stock, and from our side, I'm mainly trading the over-the-counter products, so the OTC plus the exchange. So a very important reason why some user may choose to use exchange-listed products instead of, like, say, the OTC product is about the valuation. Let's say when Mr. Wang, you are calculating your day and P&L, you usually use the EOD closing rate of the exchange. Well, if you are using the OTC products like FX swap or FX forward to calculate your P&L, usually you need to have a third-party valuation model for you. Or you need to set up your own valuation model, which will get the valuation model plus the data correctly. So it's going to be a very convenient methodology if those users like funds or maybe mutual funds can get access to the FX future products listed in the exchange. Then they can simply use the EOD closing rate from the exchange to calculate the fund, PV, whatever. So that's a huge benefit for those kind of like players. Another thing is the cash settlement. So investors no longer need to exchange the full amount of the FX risk you are going to hedge, but you just need to settle it in the difference between the contracts you purchased versus the settlement price. So that actually saves a lot of capital. Personally, I hope to see more currency pairs launched in the near future in Bursa Malaysia. So that can help traders like Mr. Wang and other firms with multi-access to different markets, a stronger tool to hedge their cross-market FX risks. Yeah, thanks.
Okay, so the next question is specially designed and put together for Mr. Zhang, right? How does the evolving role of renminbi in the international financial scene create new opportunities for people, individual, businesses who wish to capitalize on it? But having listened to your presentation earlier, I think you have pretty much covered some of it. But I think the audience would like to hear from you again so that you could present your ideas again so that it will stick to their mind. There's a second part of this question. Is CNH less volatile versus other emerging currencies? I think you have also covered this earlier. So maybe you can briefly respond to this.
Sure, thanks. Apart from what we have mentioned earlier, the increasing trend of RMB usage is mainly based on real demand. So I think the opportunity might arise from the changing environment as well. We all know that the interest rate of RMB has been relatively lower compared to other major currencies, as I just mentioned, which might raise some concerns from any investment perspective. On the other hand, RMB can benefit from this opportunity as well to develop its funding feature. As I mentioned earlier, offshore RMB bond issuance has been growing at a fast pace, especially after 2012. Most issuers are starting to fund RMB in CDPP public placement deals in the offshore RMB market. And both issuers and investors are quite diversified, which provides more valuable and safer assets for RMB holders and more choices for borrowers to mitigate potential concentration risk and the liquidity risk as well. So to answer the second question about the volatility, as I just mentioned, say CNH, the annualized volatility is around 5.2, and the Malaysia Ringgit is roughly about 6, and CNH Malaysia Ringgit, the direct cross volatility is less than 5%. So we can see that currencies, in addition to the data I just mentioned, and we all know that all the currencies have experienced significant fluctuations in the short term, which have a bigger impact on the investment returns. In the past, equity or PE, private equity fund managers might not have even cared about FX risk, but now there are people especially dealing with FX risk in the PE or equity funds. Also, Mr. Wang mentioned when they are trading, like say, the cross exchange commodities, they don't sometimes. I think before they are not, like say, take seriously on the FX risk because the commodity realized volatility is going to be way higher than FX side. But nowadays things might change. So I guess probably commodity trading firms like Mr. Wang host can arrange a higher person specialized in FX trading to handle those kind of risk. And we also have done analyze the overall performance of all the currencies over the past 10 years. And we found that actually CNH is the third best performing currency on average during the period with relatively low volatility. Even this year, with significant interest rate divergence between China and other countries, we still see that the realized volatility of RMB FX is lower than that of Euro, Yen, Sterling, Aussie, and some other emerging currencies as well. So overall, the CNH volatility is actually quite low. Thanks.
Okay, so I'm getting a little bit personal here, but in a good way, right? So the next question is for Mr. Lee. With regional free trade pacts such as RCEP and CPTPP, how will these economic cooperations help the development of economies, international trade, and financial markets, particularly in the context of Asia or even China?
Thank you, thank you. I think this is something that we've been pushing very hard, right, globally. Free trade, no longer like protect your market like what US do. I think the CPTPP started in 2018. Yeah, Malaysia is part of the member, and China is going to apply. So India is still waiting for India to come into RCEP. So RCEP is in 2022. So to understand how substantial potential that you can create from all these two pacts and how would the impact on the global economy, trade, financial flows, you look at in terms of their percentage share to GDP, global economy, the population, and trade. I think you look at RCEP 15 economy, they accounted for close to 28%, or 30%, 30.8% of the global GDP, value about 27.6 billion US, huge. And population-wise, about 29%. And trade is about 26%, equivalent to about value about 15.7, yeah, called the trillion. Then you billion. And look at CPTPP, 12 members. Their size in terms of GDP is about 15.7%, and population 7.3%, trade is 17.6%. And based on all the study, whether it's World Bank, IMF, private study, they are coming to the same conclusion. Yeah, the RCEP, the CPTPP will enhance the world income, world trade. I think the percentage is very significant. To give you a perspective, in terms of the RCEP, overall members of their GDP can increase by 1.5%, but in terms of the value-wise, it's about 654 billion US. Yeah, in terms of export, it's about 24.4 billion increase annually. So that is creating a big pool of trade flows, and that will also come accompanied by your financial flows and also the people-to-people movement. I think the moment you talk about market accessibility, for simple reason, RCEP, between China and Japan, or even Korea come in, they don't have their individual free trade agreement. So when they are in this big family of RCEP, that help to widen their access in terms of market, in terms of investment flow services. In the case of Malaysia, by going into CPTPP, we can access to Peru market, we can access to Mexico market. So that open up. So it depends on how the business, how do you leverage on the platform to widen your product and services. But of course, each of you have to maintain your standard. The more competition you have, the more you have to focus on how good your product quality, your standard, your services, that will open up. Yeah. The only thing that we realize these two pack, they never touch about currency cooperation. There's a lack of that. But it's okay. But some of the ASEAN country has started their initiative beginning May this year. Let's work together and look into the currency cooperation, which I mentioned. Yes, Indonesia, Malaysia, Malaysia with other country. Can we explore? Either we use renminbi more, or we use our own currency, bilateral currency. But before you move into using your currency, you must meet 3 criteria, which I mentioned as a store of value. Is it used as a store of value, unit account, and medium exchange? For other country to use your ringgit, first of all, you must be liquid. You must proven that your ringgit is very stable in the international currency market. I just give an example, just like renminbi, Japanese yen, or US dollar. Why US dollar is still the king? Why? Yes, US dollar as a reserve currency has fallen, but as of today, it's still about 58%. And renminbi is slowly coming up. But for renminbi to be well accepted, you must meet the 3 criteria. I think in terms of liquidity, you must have more liquidity in the market. Then people will have renminbi, into their either reserve or use it for their cross-border. So in a nutshell, I think this is a good development coming from RCEP and CPTPP. And I believe when China is finally admitted to CPTPP, without US coming in, to create a lot of tension, so that would be given more catalyst for the global and regional. And I very positive about RCEP to drive the whole regional trade flows and investment in this region. And I think India will realize that they missed the boat. For those who are in the RCEP or CPTPP, you have the first mover advantage. Those who come in later, you have to abide to our term and condition. But definitely the big nation will be even have a bigger say in a way. Yeah.
Thanks, Mr. Lee. So, Mr. Wan, the next question is for you. Considering your role as a professional trader, how do you utilize derivative products like FCNH, futures for risk management and speculative purposes? Can you share an example on how these instruments has been effective or rather instrumental in your trading strategy?
Sure, thank you. Speculative purposes, that's very straightforward. Like the charts I've been showing you guys just now. Right now, as you all know, I'm quite bullish on the CNH, right? So if I were to use this instrument to trade based on this speculation, right, I would actually outright to short this FCNH, right? And the whole idea about what I mentioned, the market lacks certainty, right? So I could be wrong, but the chart tells me that right now my risk reward is very, very skewed, right? I could be looking at maybe 4-1, 5-1, or even 6-1 kind of odds, right? Which means if I'm wrong, I know I'm wrong early, I can get out at a very small loss. But if I'm right, I know there's a long way to go, right? So this is, one of the most straightforward way of using futures like FCNH for speculative purpose. For hedging purpose, maybe I will expound a little bit more about the kind of relative value trades or the pair trading that we have been doing, because I'm sure, I guess some of you may not be so familiar, right? So we usually try to find all kinds of product pairs, products pairs as in those products that are highly correlated, right? Like, we could be, some other examples, we could be talking about the palm oil versus bean oil, right? These two are close alternative edible oils. So logically speaking, when the price move, they should move together, although at different magnitude, right? So this is where some of our alpha or some of our strategy is trying to capture. So when you put on a trade like this, what you'll be doing is you'll be buying one asset and shorting the other one at the same time, okay? So when the market moves, you realize that one asset start to make money and the other one start to lose money, right? And then if these two assets are denominated in different currencies, you realize, oh, I'm starting to accumulate. For example, during that time when palm oil rallied from 3,000 to 8,000, right, last year, if you were long the FCPO, you short the bean oil, for example, you will start to realize you start to accumulate a lot of ringgit on your account. But at the same time, your USD start to go into very deep deficit, right? So this is the time, especially with all the geopolitical tension, all the volatilities in all markets, not just commodity markets, but also in FX markets. This is the time we really need to be very, very careful about our currency exposure, right? Like I said just now, our intended risk to take is on the pair itself. We don't intend to take any currency risk. But the fact that when market moves, you start to accumulate one currency and lose another currency, you implicitly have a currency position. And this is something that we need to actively manage and actively hedge away, right? So FCNH would be a great tool for that, especially next year when BMD start to launch this soybean oil contract, right? That's another fantastic product that we can pair trade with FCPO or even the seaboard bean oil. So all these, when you trade inter-commodity, inter-market, multiple currency contracts, it is essential to manage your currency risk. Thank you.
Thanks, Mr. Wan. Last question before we move on to the question coming from the audience, right? So what are the initiatives to increase the use of renminbi for settlement of cross-border trade? We already know that the usage of renminbi has been increasing. What else can be done to encourage more usage of renminbi, especially in ASEAN?
Okay. So I believe, from my perspective, there are mainly two factors driving this initiative to increase the use of RMB for cross-border trade and financial settlement in ASEAN. Firstly, diversification. As mentioned by our panelists, market participants, including business and financial institutions, are increasingly seeking to diversify their currency exposures and reduce reliance on a single currency, such as US dollar. This diversification strategy aims to mitigate currency risks and enhance the efficiency of cross-border transactions. The growing economic ties between China and the ASEAN countries provide a conducive environment for the increased use of RMB in the trade and financial activities. Secondly, the demand from the real economy plays a crucial role. As trade volumes between China and ASEAN countries to rise, there is a natural demand for using RMB or Malaysian ringgit as a settlement currency. This demand arises from the need to facilitate smoother and more efficient trade transactions, reduce foreign exchange risks, and enhance mutual benefits for companies and institutions conducting business between Malaysia and China. And another thing I want to add on is, in addition to the three factors Mr. Lee mentioned to be a trade finance currency, the currency is actually not only it's not only about the liquidity for the trade currency, but also about the accessibility. Say if you are trading using the Thai baht, and the Bank of Thailand has restriction on the offshore Thai baht, so it's not very easy for offshore entities to hold the offshore Thai baht, which will create a problem for the settlement if you are using the Thai to settle those trades. So based on these factors, I believe there will be opportunities and challenges that companies and financial institutions have recognized. By leveraging the closer relationships resulting from current and capital account integration, there is significant potential for further development in the use of RMB for settlement of cross-border trade and financial activities. Yeah, Mr. Lee.
The journey for internationalization of renminbi will come with up and down, okay? So, but I think the direction is very clear. Everyone knows that direction. Renminbi both offer as the choice for you and also opportunity for you in the markets, right? So I would think there are 5 initiatives which the central bank, government can consider. The first one, which I call is very business-related, networking effects. Networking. Why? Because the attractiveness and intrinsic value of the renminbi is derived from the existing user. Like you are the business user, you are investor, institutional clients. If you have been using this, and the more renminbi is being used, there will be more entity will likely and willingly to trade with you to use renminbi. And the wider use of the renminbi effectively, by right, it should also reduce the cost of using renminbi to settle. Yeah, one. Second is about infrastructure. I think we know China has done a lot in terms of improving the infrastructure, come out the more renminbi product in terms of financial solution, continue to enhance that together with the banks, the central banks. So like in terms of the intercurrency payment system, you should eventually, I would think if we go and more of this cryptocurrency product, or digitalization, which effectively reduce the cost, maybe that one day will come, US dollar will be no longer such a currency that we have to invest in. You know, there'll be more diversification. And third is about awareness. I think that awareness have to be continued to enhance in the local market. I think I remember before I joined the Chinese Chamber, our central bank, Bank of Malaysia, has worked with the BOCM, conduct workshop to educate people about this, why renminbi is an alternative for you to use to settle your bilateral trade. Yeah, so that involves the cooperation within the banks together with the central bank, and I think central bank is more willing to work with the local banks, yeah, in order to create more awareness about the renminbi. And fourth, what I say is the cross-border payment. Simple. You just have to continue to reduce the payment delay, improve the efficiency, and reduce the cost of transaction. And I believe all this will flow. It will come. Yeah. And lastly, which I continue to emphasize on, China, you want to internationalize your currency. It's about, you have done a lot in terms of economic integration. The financial integration is a bit limited. You can see the global payment share is about 3.6, 3.7%, and people are still slowly accept the renminbi. So you need to enhance further your market in terms of liquidity, in terms of your regulation, and most important, to create the investor had the credibility, confidence of holding your currency, yeah, and stable. This something is a long journey, but I believe one day it will come. But my personal stand, we should not expect a very abrupt type of de-dollarization, because each of us will hurt badly, because most of our reserve is in the dollar asset, yeah, dollar asset. If one day dollar crash, each economy will suffer first, then only thing will start to stabilize. So it's foolish to think that one fine day you wake up, everybody just dump the dollar. It may come maybe in one day, because dollar is always think that they are the king. They can print as much as they can, because there's no risk, right, to fund their deficit. Until one day you find that, oh, I don't think US can service or default. Yeah. So maybe that day everyone will just dump. But the moment they dump, the whole market will be chaotic. It will be chaotic. And I believe all the major central banks will come together and come up with coordination how to ensure a gradual de-dollarization over time, rather abrupt. Yeah, that would be quite disastrous. Thank you. Yeah.
Thanks, Mr. Lee. In fact, we have a couple of questions coming from the floor, but for the benefit of time, I would only choose one to answer. And to be fair to me, I choose one that I can answer. Give me one chance to respond to one question. It's coming from Tay. How to compete with SGX and Hong Kong Exchange, since they already have this CNH contract, right? So as an exchange, we don't really see other exchanges as competitor all the time, right? So as you know, this FCNH contract is actually a licensed contract from Hong Kong Exchange. So we do work together. We don't compete all the time. And what is the positioning of this CNH contract, right? It is actually part of our strategic business plan of BMD, of course, right? We will be launching more contracts that are related to China. In fact, we are looking at more product collaboration with Chinese exchanges. For your information, soybean oil contract that's licensed from Thailand Commodity Exchange will be launched sometime early next year. Yeah, so that's already in the pipeline. We do not rule out more product collaboration with Chinese exchanges again. So that's the reason why we have this CNH contract listed on BMD, because we want to encourage hedging of this exposure of trading these contracts being done. You can actually trade and hedge currency exposure on the same exchange, which is BMD. Yeah, so that's the reason why we launched this CNH contract. It is not actually to compete directly with Hong Kong and Singapore. So this is my response to this question. Lastly, I would like to share the final outcome or the final result of the poll. 60% of people who responded think that the renminbi will appreciate 2% against the US dollar next year, right? 20% think it will depreciate, 20% think that it will be flat, yeah? Within the 2% movement. Again, we are already seeing some trades for this FCNH contract. Not many, not thousands of lots, but we have seen trades already being transacted. We already have market makers arranged to put in prices, sell quotes and buy quotes at the same time. We are in arrangement with the Bank of China for Bank of China to come in as a market maker as well. We welcome you. So I guess that concludes our panel discussion session. Thanks again to all three esteemed panelists.
Thank you very much, gentlemen, and please remain on stage here together with us. As on behalf of Bursa Malaysia, we sincerely appreciate you for taking your time for joining us here. Hence, may I invite Mr. Salim Kader Bakas to present a token of appreciation to our esteemed speakers. Well, here we'd like to invite Mr. Salim to first present a token of appreciation to Mr. Lee Heng Jui, Executive Director of Socio-Economic Research Center, ACC-CIM. Thank you, Mr. Lee. And here we would like to invite Mr. Wan to step forward and receive a token of appreciation from Mr. Salim. I also would like to say a big thank you to Mr. Cheng Dongzhang, Chief Dealer of Global Markets at Bank of China, Hong Kong Limited, for joining us here. And shall we have a group picture together, please? Beautiful picture capture. Thank you very much, gentlemen. Please return to your seat. Continue to enjoy the rest of the session. Thank you. Well, ladies and gentlemen, as the clock approaches 11:30 a.m., we find ourselves at the end of this enlightening journey. On behalf of Bursa Malaysia Derivatives, we extend our deepest gratitude to the distinguished speakers and panelists. And if I may, let's give them a big round of applause for sharing us their insights. Thank you. And to every one of you here, thank you so much for attending this amazing session and joining us at this official launch of Unlocking Trading Opportunities with Malaysia's first currency future contract, the Mini USD CNH Futures. We appreciate your attendance here and we would like to wish every one of you good day ahead. And continue to enjoy wonderful networking sessions here together with us. And for our friends joining us online, thank you very much for participation. We wish you good day ahead and goodbye. See you again.